Welcome everybody. It's Friday as always, and time for another live stream. Looking forward, as always, to the session today and an opportunity to review what's going on in the markets, especially as they relate to some of the positions that we have open right now, and to hopefully give all of you good morning, Gib. Welcome. Give all of you an opportunity. Hopefully, we'll have some time to look at some of the stocks that you're following as well, and give you an opportunity to have the group kind of offer opinions and get some other perspectives about them. It's an opportunity for us to share perspectives and differences of opinion about some of the things that we're looking at. So certainly don't expect everybody to do. You may be following my trades, but you certainly don't have to do them the same way. So we'll be looking at some of the open ones and talking about how current conditions impact those. But really excited to have you here, and we'll hopefully we'll get a few more coming in. Looks like we had some at the beginning that dropped off, but hopefully we'll get a few more back. Okay. Just by way of introduction, if you are perhaps listening to this live stream after the fact, or if you're new to it and live, then just kind of give you an introduction to the Rebel income system. This is all about income generation using options, and specifically operating as an options seller. What that means is that instead of doing what most people do when they think about options trading, which is to buy a call because you think the stock is going to go up, or selling or buying a put, excuse me, because you think the stock is going to go down. We, instead of being the buyer in these transactions, we take the selling side. There's a lot of reasons for that, and one of the primary ones is not only the income that being the seller provides. There's an immediate income, an immediate credit that comes into the account, but also about trying to turn probabilities in our favor. My own experience and a lot of different studies out in the market that are available for everybody demonstrate that the probability of success when you focus exclusively on the long side of the market, being the buyer, means that your probabilities are going to be very low. You're going to be wrong 75 to 80% of the time in most cases. And if you're really, really good, it might only get up to 70%. So you're going to be wrong. Even the best, most professional traders in the market who focus on the long side of the market are still wrong more than 2/3 of the time. You're only going to be right that often. That means that you have to be able to maximize profits really, really effectively on those winners, and even more importantly, limit the losses on those losing trades. And so there's a very, very hard discipline that has to be learned with that. That is contrary, I guess is the best word I can think of, to most people's mindset and their financial, emotional, or intellectual ability to withstand. It takes time. It takes a lot of money. It's like paying tuition, going to college, and most people can't afford to do it. And so my method is to try to look at those same potential trades and think about them from a different perspective, from the perspective of the seller. If the buyer is going to be wrong 2/3 of the time or more, then that should mean that the seller is going to be on the right side of the market. Well, I want to be on the right side of the market. So we focus on selling, both to generate income as well as to improve probabilities of success. Now, one of the things that is really, really important about put selling to remember is that when you sell a put option, you are giving somebody else the right to sell the stock to you at a higher price at some point down the road. We'll take the trade that is expiring today on Nike. This is a put sell that I placed at the beginning of the first week of October. I sold the $68 strike price. What that means, by selling 68, that means that if the stock is below the strike, below 68, at any point leading up to the expiration date, which is today, they could force me to buy the stock from them at 68 by simply going and buying the stock in the market at whatever its price is, 66, 65, 60, 50. Who knows? We'll take a look at it here in a minute and see exactly where that stands. And then force me to buy it at 68. They profit by keeping the difference between those two prices. Why do I accept that risk then? If there is all of this potential downside? Well, the first reason is because 70 to 80% of the time, that's not the way it works out. Usually these put options expire worthless, which means that the stock stays above the price that I've sold. There's also the income component. In this case, I brought in $1.40 in income on this for about a 2-week period of time. That was 2% in terms of total premium. And if you think about that, if you can do 1.5% to 2%, even on a monthly basis, you're doing really, really, really well as an investor. And so these are very short-term trades. And by focusing on not only the sell side, but also by selling a month or less, I'm taking advantage of another element of options, which is time decay. With options for buyers, time decay is a risk. It creates more difficulty in being profitable because not only do you have to be right about which direction the stock is going to go, you have to be right at the right time. And that can be a real killer. I've had a lot of long option trades where I thought the stock was going to go up. It did. It was just after my option expired. And so I lost a lot of money simply by being wrong about timing. Well, if that's the case, then the probabilities are better on the sell side, and also by using time decay as an asset rather than a risk. And that's by selling very short periods of time. I try to focus on 30 days or less. Okay, with that in mind, then that's kind of the overview. Let's go ahead and dive in. I've already kind of introduced the first stock on my list to pay attention to. And by the way, if there's some things that really resonate with you today in terms of what we talk about in the session, there's a couple of things you can do. First of all, if you like what we're talking about, please do go ahead and give the video, the normal YouTube like. If you haven't already subscribed to my channel, please do. That's also always useful. The right side of the chat as well is an area that you can provide reactions and comments. Feel free to use that as Gib did this morning at the beginning of the session. The reactions area is where you can just use emoticons to respond to different things. The way that kind of like what I'm showing you here right now. Whatever your preference is. Jay, welcome. Welcome. Good morning to you as well. Okay. So with Nike then, as I mentioned, selling the $68 strike price, let's go ahead and check in on that one and see exactly where we stand. Okay. So the stock is has been showing some momentum for the last probably 2 weeks, coming off of a low point here, probably around 65. That's an ugly 65, but whatever. The last 2 days has pushed above both the 200 and the 20-day moving averages, which could be a pretty strong sign of a trend reversal to build on a short-term trend reversal, I should say, to build on what is now becoming an intermediate upward trend. So that's interesting. Stock is just a little bit below 70 right now, and so the strike price I sold here was 68, which is obviously quite a bit below that price. So that means that this option is likely to expire worthless. That opens up a couple of different possibilities to think about in terms of managing this trade to maximum effect. My normal method here is to, what I can say is let the result be the result. And that means that I go ahead and I let the option expire. And if I get assigned, I get assigned. If it expires worthless, then so be it. The caveat to doing that, and accepting that kind of a result is that the money that you reserve for the trade, either with margin or cash, I prefer to work on a cash secured basis whenever possible. The money that you use to reserve the trade is held until trade settlement completes. And that can take anywhere from 2 to 3 days in most cases. So for me, that means that the $6,800 that I used to reserve this put sale on Nike at 68, I sold one contract. So that $6,800 I have to keep in reserve for the duration of the trade. That won't be available for a new trade until Tuesday, probably Tuesday, maybe possibly Monday, most likely Tuesday. That's normal trade settlement with most brokers. And I'm okay with that. That actually works out just fine with the way that I trade. I'm not going to be looking for my next trade until I send out an alert next Tuesday, which means the earliest I'm going to be looking for my next trade is Wednesday. So trade settlement is fine for me. However, there is another way that you can look at this, and that is with the stock nearly $2 above the strike price that I sold. And if you were working with the same strike price, and by the way, I always like it when people share their numbers. So if you're in the same trade, please feel free to share. With it nearly, well, it's now 69.75, 73. It's moving a bit. A little under $2 below the strike price that I sold. That means that there's an opportunity to think about what some other possibilities may be. Now, just for a review, remember I brought in $1.40 per share on this trade back on the 8th. So that is the amount, that is the credit that has come into my account. When I set up this trade, I sold this option. It was a sell to open transaction with my broker. Now we can see the asking price for this same contract is 7 cents. So I brought in $1.40. What that means is right now I could put in a buy to close. I'm going to BTC. I'd pay 7 cents to buy the option back. That would close out the potential obligation. And I would end up keeping $1.33 of my premium. Now, I'm going to open this up a little bit to the group. I know we talk about this each week, but what is the advantage? What is the advantage of buying this back before the market closes today, as opposed to waiting, which is my normal method? Why would I want to give up any portion of this premium? Thank you, Jay. You're exactly right. Getting my money back quicker. Again, the reason I kind of took a couple of minutes to talk about trade settlement is because the logistics of how trade settlement works can impact the way that you manage your trades. And the way trade settlement works, if you let an option expire, you're going to deal with the normal trade settlement. If you buy it back before the market closes, you sold to open, now you buy to close, that $6,800 that I put in on reserve, yeah, return is passing your requirements. There you go. Thank you, Gib. If you buy that back, that $6,800 would come back to me immediately. If I were to buy this back right now, just put in a buy to close order, pay the 7 cents, and I would not only would that $6,800 become available immediately for me to redeploy in the market, but I would also hang on to $1.33 of my premium. I'd only have to give up 7 cents in order to do that. Now, so think about that $1.33 for a minute. Let's just keep that in mind. And we've been in this for 16 days. This trade was placed on October 8th. Now, let's take a look at what it begs the question, what do you do next with the same capital? Well, I could roll up and out a week. Here's the $69 strike price, and the bid on this is 75 cents. It's a little over 1% for 7 days, which is actually not all that bad. But how about $1.27 for 69 for 14 days? That's interesting. Let's take a look at the, yeah, we have plenty of open interest here. I'm usually looking for open interest in excess of 100 contracts. Any kind of volume is useful. I'm not necessarily looking for a minimum amount of volume here, but this is a contract that is more than liquid enough to make this a possibility. So let's go with $1.27 for a second. Let's think about this in practical terms, just in terms of that contract itself. Is that a practical trade? This is for 2 weeks of time. We do $1.27, divide that by 69 because that is the strike price we're selling. That means that is I'm selling the right for somebody else to force me to buy the stock at 69 potentially if I were to do this. So that's 1.84% for exactly 2 weeks of time. Now this is a little bit less than what I was able to do with my last trade. But this would extend it out to roughly 30 days and would add $1.27 to the $1.33 that I brought in, that I finished with by buying today's contract back, hanging on to $1.33 plus $1.27 on the new contract. That means that I would generate $2.60 in premium for 2 different trades. Okay. One contract, that's $260. And since the first contract was 68, the second is 69, to try to figure out what my net return is here, I'm going to split the difference, call it $68.50. And that's 3.79% for a 30-day period of time. Okay. That means that if you can do this every 30 days, you're going to be able to place about 12 trades. If you can repeat this kind of result 12 times, you're doing in excess of about 45%. So that's pretty attractive. That's interesting. And I know there are some people in this group, if they were here today, they would be screaming in the chat comments, why aren't you placing this trade right now? And that's okay. This is one alternative. This is one opportunity. This is what I call rolling. And a lot of the people in our group who like to manage their trades more active, they're rolling on a regular basis when they have an opportunity. They may not be waiting for the day of expiration to do this. They may be doing it within a few days if the stock has moved enough to give them an opportunity to do so. The other thing that this does is it accelerates compounding. And by that, I mean the net effect of multiple trades over time. My trade, if I'm going to let that expire worthless, it's a 16-day trade, but literally speaking, I'm not going to be able to place another trade until Wednesday. That's another 5 days from now. And so instead of a 16-day trade, that becomes a 21-day trade, 3 weeks, right? Well, here's the difference. 365 days, if I divide that by 16 days, which is the duration of the current contract. If I close this out today, then I could place, if I were rolling in the same way on the same time frame every single trade, then that would give me the opportunity to place 22 trades. That's 22 opportunities to generate income, to bring in premiums, like the 2.06%. Oops. There we go. Like the 2.06% that I was able to generate for the put sale that expires today. Okay. So 2.06 times 22. Again, we're in that 45% range. By accepting normal settlement, I'm going from 16 days to 21 days. It's a 5-day difference. So 365 divided by 21. Now I go from 22 trades to 17. Are you starting to see the logic here? 2.06 times 17 is 35%. This is still a very good result. Don't get me wrong. This is why I'm actually more than content with this. This is right in line with what I need. And it fits in the time frame and the way that I trade. It fits into my lifestyle, all of those things. That's why I'm willing to wait for expiration to occur, and I'm willing to accept normal trade settlement. I am also actively accepting the fact that I'm giving up about another 10% or more, possibly, in terms of my total return per year, just because I am not managing my trades more actively. So for those who, if you are trying to manage your trades more frequently, if the idea of rolling makes more sense to you, then this is exactly why it's a real, it can be another way to create an advantage in the market for yourself that a lot of people are just ignoring. Again, talk about the low-hanging fruit of the market. It's not just the fact that most people don't think about selling options. It's also they don't think about ways to leverage those opportunities. Nike is starting to drop. Yeah, 69 cents, giving up 25 cents just in the bit of time that we've been talking. It is unlike I find it will probably odds are pretty good that it will not break 68, but we'll see. Anyway, does that make sense? Are there any questions? Any other comments about Nike? All right, Gib. Maybe it's me, but I always review the stock before I roll. Yeah, absolutely. You 100% sure should. Not only what is the stock doing from a technical standpoint. Okay, Jay, your call is at 69, so you're a little bit closer. So you've got something a little bit different to concentrate on, right, and monitor, which is fine. You were probably able to bring in a little bit more on premium on it than I did. Maybe it's just me, but I always review the stock before I roll using your system. Gib, I just want to go back to that. I really appreciate that comment because that's always useful. And this is true not only when you're about to place a new trade, but also if you are thinking about making an adjustment midstream. Are you going to roll or are you not? I think that another review, and we're not just talking about looking at the current price action. Have the fundamentals changed? Is there a new earnings report coming up? If I'm going to place a new trade, is that going to cross a new earnings announcement? If it is, then that is probably going to have an impact on the stock's volatility. And so I need to try to think about that and decide if I want to do it. Yeah, that's a great comment. The trade that I placed, in fact, on let me try to think, it was either CAG or EMN. It might have been Eastman. Yes, this week's put sale on Eastman is a really, really good example of what you're talking about. This one, this trade crosses, this expires after this earnings announcement. I did that understanding that that was the case, and that's okay, because the strike price that I sold is a screaming deal if I were to be assigned. But I'm also explicitly, not tacitly, but I'm explicitly accepting the fact that the stock is going to start to get a lot more volatile, and we could see some severe price action even before the option expires. So that's another element you have to think about. So absolutely correct. You should always review the stock before you place a trade or before you decide whether or not to roll. I really appreciate that. Okay. So that's Nike. And with that in mind, let's go ahead and take a look at the next one. This is a stock that expires on Halloween. I guess you can take that as you want, scary or not. I don't know. Maybe that's why I decided to work with a food stock. It's just kind of basic and it's not scary, right? Conagra is a stock I've used before, and in this case, I was able to sell the $18 strike price and bring in about 44 cents, about 2.44%. Again, another 16-day trade on this one, and I sold 3 contracts on this one. So this is more than what I did with Nike. That was absolutely a function of the lower stock price. But the fact that I sold more contracts, this is important to think about. One of the things that we have to factor in is our risk exposure on every single trade, and that is a function of position size. How large is the position that we're taking? Well, I already talked about Nike. Selling one contract at 68 meant that I was putting $6,800 out there into the marketplace. With Conagra, I sold 3 contracts. So now I'm looking at possibly having to buy 300 shares at $18. That sounds a little more severe, right? But the question is, what's the total amount of money that represents? Okay, so 18, since 3 contract controls 300 shares, I'm just going to multiply 18 by 300. That's a total reserve requirement of $5,400. So that's actually still less than what I was looking at with Nike, which was around 68. So this is still a very conservative position size. As a percentage of my overall account, this is very conservative. Oops. 5,400 divide by 302. There we go. This is less than 2% of my total account. So this is a very conservative position size, even though I sold 3 contracts. And so that's well within my parameters right now. Under the best circumstances, I usually suggest that you limit the size of your put selling trades to no more than 5% of your account's total size. That not only limits risk, but provides for quite a lot of diversification in your account. And it makes it a lot easier to manage your trades. Over the past few years, and certainly during the pandemic, I went even lower. The last year or so, I had been between about 2 and 3%, and now I'm if I can go below 2%, then I'm doing that pretty actively. All right, Barry, thank you for sharing your trade there. The only thing I need is maybe this is $38 call. Let me know which stock that one was on. Be happy to look at that. So thank you for sharing it. Okay. So Conagra at 18. Let's see where this one is at. The nice thing on this too is that it is a week from expiration. Oh, that's on Intel. Okay, great. This is a week from expiration. So the dynamics are a little bit different. We're not up on the day of expiration. And so there may be a little bit more movement associated with this one. And so let's see where we land. Remember, on this one, I brought in 44 cents on my put sale. So that was the net credit on the account. The stock is a little bit above 18 right now. It is tracing back a little bit. So we'll see. But again, we're still a week from expiration. As of now, the last 2 days, actually, we've had bearish momentum. Looks like it's trying to pick up a little bit. But it's also got pretty solid support in this $18 range. So we'll see if see how much that changes or may not. I don't know. But right now, this is looking pretty good. So let's go over to Conagra. Here we go. And 7 days out, the $18 contract is this one. Now I brought 44 cents in premium in on this one. And right now the asking price is 20 cents. General rule of thumb for a lot of the people that that like to use rolling, that want to be a little bit more active, is a good rule of thumb is to consider rolling as soon as you can hang on to at least 50% of the premium that you brought in when you set up the initial trade. What this does, again, we're talking about accelerating your compounding even more. The 7 days to expiration, this is a trade I placed last week. I've been in it for 9 days. So instead of 16 days, a 16-day duration on the trade, we're shortening it by 7 days, cutting that time period almost in half. And right now, if I were to buy this back, I would be able to keep a little over half of that premium. It'd be buy that back. Here's the net credit. So I'd hang on to 24 cents, or a little over 1%, be about 1.3% for a 9-day trade, excuse me. That's interesting. And again, it begs the question of what do you want to do with it next? This is the other question. I think that if you are interested in managing trades more actively, you should always be thinking about is, what are you going to do next with the same capital? It's one thing to say, I'm going to get the money back sooner, but if you don't know what you're going to do with it, it may not have a whole lot of point. And to be honest, that's one of the reasons that in most cases, I just simply let my options expire. Excuse me. Not because not because I don't know what to look for, but just because sometimes the mechanics just don't really look all that nice. All right. So for Conagra, going out another 2 weeks, here's 25 cents on the bid for the 18 for November week 1. Yeah. This one is severely distorted. Look at the difference between the ask and the bid. Means there's no activity going on this one. There's enough open interest, but literally no volume. And so we don't even see the bid price being updated here. So that's interesting. So this one might not be as compelling in terms of trying to roll and work with the same stock if you wanted to try to manage the trade more actively. Then again, if you want to try to bring that $5,400 back into the account, you had an idea for a different stock you might like to work with better, that could also be a good reason to think about rolling and buying back and moving on. So that could absolutely be worthwhile. Okay, let's check in on Barry's trade because you've got me intrigued, man. Intel has been picking up a lot of momentum since August. Here we see it started into this nice little upward trend, and then all of a sudden, boom, it started to go parabolic. A lot of this action has to do with some deals that Intel made with NVIDIA, where NVIDIA has injected quite a lot of capital into Intel. So a lot of it related to their foundry services. And that's provided a pretty big boost to the stock. But obviously, Barry is taking advantage of it. He had a $38 call last week that he brought in 75 cents on. And let's see, your cost basis is just under 35. So let's run with these numbers. I'm going to change my color a little bit, make this a little bit more visible. Barry, cost 35. I'm just going to call it 35. You say it's a little bit under. We'll go with 35 for the sake of argument. And last week's trade sold covered call, CC, at 38. Brought in a 75-cent premium for that call and bought it back for 10 cents, which means that he held on to 65 cents. And that's in terms of, sorry. Here we go. Get my icons correct. There we go. Okay. .65 divided by 35, 1.85%. Now he just sold a new one at 40, with the stock picking up momentum. It's coming back down now, but still selling 40. Bring in $1.25, so you were able to get a little bit more premium on this one. That's nice. 3 contracts that are expiring today. And so it looks like that's going to expire, right? Because the way the stock is trailing back off of that peak today. So it's $1.25 expiring. So your net credits on this, $1.90. Or divided by 35, 5.42%. Again, this is a nice result. This is better than a nice result. This is a very nice result, right? 5.42%. That's nice. Awesome job, Barry. This is a really, really good example of not only the rolling aspect with covered calls, in this case instead of put sales, but it also is a really, really good example of why I like taking assignments, is because when you own a stock, you get some of these kinds of opportunities to keep the income engine going with covered calls. You can apply the same kind of rolling methods that we've been analyzing with these put selling trades with covered calls. I like to focus on dividend paying stocks, which means not only do I get the income coming in from the premiums that I sell, but also from the dividends. Intel used to be one of those. And to be honest and clear, I have a position in this stock in the 50s from when they were paying dividends. They haven't paid a dividend in a little while. And so right now they don't qualify for any new trades. But they are showing some nice momentum. Yeah, it was at one point, 1 million percent. And I'm also confident that at some point they're going to reinstate the dividend. But there are some other things that have to happen first before they do. So, okay. But Barry, this is a nice trade. I'm going to give you two ticks for two covered calls. They're giving you two really, really nice results on this stock as it's picking up momentum. And your cost is all the way down here at 35, and actually a little bit below that now with all of the premiums that you've been selling, right? So that gives you a lot of room to work with, even as the stock has picked up some more bearish momentum just while we were talking about it. I promise it's not us. Maybe it's karma. I don't know. Okay. Thanks for sharing that, Barry. I really appreciate it. The other trades that we have going on are were all placed this week and aren't set to expire until the third Friday of November. And so we can go ahead and check in on these really quickly, see how they're doing. First one was Eastman Chemical. This is a new trade into a stock in the materials sector. I already have a couple of these in my portfolio now that I've been holding on to for a little while. Eastman, though, is really at the very, very low end of its long-term downward trend, and very, very undervalued. So that setup made this particular trade interesting. Here it is now at 63, a little bit above it. Wow, it's picked up quite a bit of momentum. Selling the 55 on this, bringing in $1.05 for 30 days, generating a little under 2%. Now, why the 30 days? This is a stock that, unlike a lot of the other ones we've looked at, only sells monthly options. There aren't weekly contracts available. Okay, so Barry, you counted those premiums and a couple of dividends that you collected to arrive at the 34.78 cost basis. Gotcha. That's perfect. Okay, so this is at 55, bringing in $1.05 with it at 63 now. You can see it's clearly building, even if it doesn't look all that impressive. Actually, it kind of is. When I placed the trade, it was here, just a little bit above 60. Not only does this only offer weekly options, but the options are also work in $5 increments, which is kind of funny in kind of an annoying way. This actually often makes trades a little bit more difficult. Barry brought in $2.50 for the $60 strike. Awesome. So you did better than I did. You went a little bit more aggressive, but that's a relative term, right? The stock is at 63. You've got some room. I went down here at 55 and was able to bring in about $1.05. I took that one over 60. I was planning on the 60, to be honest. That's the one that I sent out the trading alert for, was the $60 contract. I saw 55, and again, because of the fact that the stock is coming up on an earnings report, and this trade, these contracts cross, that earnings report comes before these options expire. So implied volatility on these is more than a little bit inflated, and that created an opportunity for me to bring in a little more premium. So I did bring in a little bit more premium, but also go about $5 further out of the money. So I was setting it up purposely to be a little bit more conservative. Yeah, Barry considered the $55 strike as well, and you just went for the larger premium. That's fine. It's fine. This is one where I was talking about how sometimes the logistics of what are happening in an options chain make it a little bit harder to roll. EMN is one of those. When you see stocks that don't offer weekly options, rolling does become a little bit of a different conversation. It really usually becomes about thinking about whether there's an opportunity to buy the option back, close out the obligation, and move on to a different stock in most cases. Because not because there's anything wrong with the stock, but just the fact that there's only so many contracts available, and yeah, exactly, Barry. With $5 increments, it makes the rolling a little bit less attractive. So in most cases, I don't even think about rolling these, except maybe to close out the trade early so I can go do something else with a different stock. That's it. But in this case, this is a good trade. The asking price on it, even though we've seen some really nice bullish momentum, is still not enough. At 75 cents, I would only be hanging on to 30 cents of the premium I brought in. That's less than 50%. So there's not enough movement here yet. And I wouldn't have expected it only a couple of days later. Come on. So, Barry, come on. You don't consider the rolling no matter. I'm just trying to put everything in context. Thank you, Mary. Calling me out. That's fine. I got no problem with it. All right. That's EMN. The other trades are some covered calls. These are from stocks I was assigned last week on CTRA and on Skyworks. And CTRA, I was able to sell the 24.50 strike. I have the stock at 24. This one, there we go. Showing a little bit of positive momentum here the last few days. And still not actually at 24, but again, because there's an earnings report coming up, implied volatility on its options is a little bit exaggerated. I'm using that as an advantage. I don't know what the stock is going to do in response to its earnings report, but I am taking advantage of the opportunity to generate some additional income. Barry's in at 24.50. Not getting a good call entry as of yet. Yeah. And again, this is all relative to the price that you got in at, which is what Barry was talking about, and also relative to preference, right? Here's 24. I don't know, 24.50. Now let's get rid of today's contract. Here's 7 days out. Yeah, these premiums aren't great. There's your ask, 15 cents. This isn't horrible, but there's nothing at 24.50 if you go out past 14 days. This looks tempting, but here's an interesting counter. There's not a lot of activity going on here on this one. Last trade a little bit before close yesterday on this one. The asking is 6. There's also no open interest, next to no open interest on this contract, 24.50. which is really interesting. Less than 100 total. So not a lot of liquidity. You could, if you wanted to here, Barry, again, this is not a recommendation to buy or sell, but you could even go really conservative here, maybe put in a sell to open trade on a covered call here at 24.50, right? And at 40 cents, just saying, you might get it, but I would say it's probably a flip of a coin. It's probably just as likely you don't get it. And 24.50 is the price you bought the stock at. So, if you don't have an opportunity to bring in some extra premium above that, if it's if the liquidity is kind of iffy on it, it's not compelling, right? It's not super attractive. Put it in a good till cancel, but waiting to see if it, yeah. Then that's the problem with a good to cancel, right? I usually limit these to day orders. You put in a good till cancel, you increase the likelihood you'll get the trade filled, but also there's a greater chance to see if there is a gap, right? That forces prices to be even more exaggerated. So that can work against you in a lot of cases. So my trade expires 21st. And I sold the 24.50. Again, just there's just not a lot of activity, so not at the moment. So we'll see what happens. All right, Skyworks. This will wrap up all of my positions. So if there's any others that the rest of you are interested in taking a look at, please do put them in the chat area, and more than happy to take a look at them. Now, I was assigned Skyworks, as I mentioned last weekend, at $75. And this was an opportunity. I was able to sell a covered call at 77.50. The stock was rallying. Implied volatility was pretty high on this. And here's your proof. 4.53% on a covered call for 30 days. That is extremely out of the ordinary, which is why I did it. If you have that opportunity, it's like a gift, kind of like a gap. You buy a stock at 50 and all of a sudden it's at 60 overnight. That's a gift. You just take it. This was just sitting there. It was waiting. I took it. That was it. But I'm in at 75, so this was a very, very useful trade in terms of the total income. Let's look at the chart. Stock's a little bit above 73 now, but coming back a bit. It's not even really any higher than it was when I placed the trade. So let's see what implied volatility on this looks like still. Here's the 77.50 call. This is interesting. The bid price is a little bit below what I was able to bring in. And again, no volume today so far. About an hour into the trading session so far yet. But there is plenty of open interest here. So 295 there. That's interesting. This is $2.50 away from the strike price that I bought in at. This is kind of like EMN, where this is another stock that doesn't have weekly options. The increments aren't as exaggerated. There's not $5, it's $2.50, but that also tends to lessen a little bit of the rollability, I guess is what we'll call it. The rollability of these contracts is really not as attractive as what you may have with others where there's weekly options available. So obviously in case you're wondering, the idea here, I'm hold course. This is a nice trade for me for now. It may not get back up to 77.50. I don't know. I had an opportunity to bring in almost $3.50, man. So that just seemed like easy money. And I say easy money really carefully. What I mean is it's just money that was just sitting there, just waiting to be picked up. It's just low-hanging fruit, just sitting there. So it just seems silly not to take it. Okay, Barry, in my fun account, he sold TSLT put for $23, expiring on the 21st. So let's take a look at TSLT. In the way of proper disclaimers and coward's doors and all the rest of that. T-Rex, okay. I am not familiar with this ETF. ETF for Tesla, okay. That explains a lot. Long Tesla daily target. So this is a way to work with Tesla at a lower price than the stock itself, right? Got Tesla up here at $400. So there are a lot of ETFs out there like this, like NVDL, where you can work with the ETF. It gives you a little bit. You're still analyzing. You're still working with effectively the same price action, just at a lower price. So this one will move the way that Tesla stock moves. And so you're in at $23 for $1.40, and that's one. Your strike price is all the way down here, so the stock's up at $27.50, $1.40, expiring 11/21. That's interesting. Yeah, you're right. You'll see in your fun account, and that's okay, right? This is a leveraged and inverse ETP or ETF. Let's expand our contracts out here so we can get to 23. There we go. Yeah. You have a pretty high implied volatility going on right now. Is Tesla coming up on earnings? They just did have earnings, so that's interesting. Haven't seen the implied volatility contract back like it usually does yet. So that's an interesting one. Yeah, he said it may be fun like NVDL. Very possible. Taking a little bit of a ride on the wild side, maybe. But from a technical standpoint, you got a pretty tight range here going on. Pretty strong support around 25, and you're all the way down here at 23. So you're much, much below that point. Starting to press the top of the range. We'll see if it can break out. But even if it doesn't, you're probably going to have an opportunity to roll the trade, let it expire. It sounds like, or at least it looks like it's in a pretty good position for you right now. So, yeah, like you said, we will see. Thank you for sharing that, Barry. I appreciate it. All right. Well, we're pretty much at time, but I appreciate everybody who is here, and I appreciate your participation as always. Your comments. Please do, again, if you like this, go ahead and like the video. Please do share this with your friends and invite them to come and participate as well. I'm making this live stream available publicly, and that's because I want to try to expand the Rebel Income community as much as possible. So if there's somebody that that you think would benefit from the way that we're trying to analyze the market and look at the kinds of trades we're placing, please do invite them, and let's show them a little bit different way to think about the markets. Everybody, thank you again so much for your time. I do appreciate it. As always, I hope you have a great weekend. If there are any questions that come up between now and next week, don't hesitate to reach out and let me know. rebelincomesystem@gmail.com is the email address. You can also reach out to me on Discord if you're there, or on Substack. Either way. Thanks again. Have a great weekend. We'll talk next time.